It's Bennett Stewart to introduce a new and particularly powerful way to rate your business plans and set targets. It's a statistically robust technique to put your plans in perspective. It's based on a stock rating model we've developed called PRVit, spelled PRVit, standing for the Performance Risk Valuation Investment Technology. PRVit uses a total of 30 variables to size up a company's performance, risk, and valuation through the lens of EVA, and expresses those as percentile scores against the market and sector peers. It then takes the performance score, less the risk score, and divides by the valuation score. It runs the ratio of P minus R over V. It computes a risk-adjusted return on value index and expresses that on a percentile scale to arrive at the PRVit score. A stock with a PRVit score over 70 is attractively valued and is deemed a buy. Under 30, a sell, and in between, fairly valued. Each night we rerun the PRVit stock ratings for 20,000 global tickers. They are featured on Bloomberg and for retail investors on Fidelity.com. PRVit also underpins an EVA-based stock research service we provide to institutional investors in a separate wing of EVA Dimensions. We're now up to 50 clients, and this includes many of the most important and influential investment houses in the US and UK. And now, a special version of PRVit has been built into our EVA-FE forecast analysis tool. You are able to subject your forward plans to a big data comparison and see if your plans are likely to generate an attractive or unattractive return on your share price or on an appraised value for your company. To illustrate PRVit, I'm going to present a case study on Standard Motor Products, a manufacturer of auto aftermarket products with close to $1 billion in revenues. I'm going to pull a consensus forecast into EVA-FE and use that to develop an initial PRVit rating. I should emphasize that in practice you will want to enter your own plans and use PRVit to rate your plans and your goals, but consensus is what I have available. I next use FE to revise the forecast, just as you might revise and enhance your own business plan, and see what that does to the PRVit score. This process also provides a good overview of many of the EVA-FE analysis functions. Here's the consensus forecast. Analysts are projecting that S&P's EVA will triple from 9 million to 27 million, mostly because they foresee the firm's EVA margin increasing from 1% to 2.3%. Sales growth will average only about 4% a year. Put it together and the forecast EVA momentum averages 0.4% a year, the classic S&P 500 median. The intrinsic value from discounting the consensus EVA and cash flow forecast works out to $42 a share, beam on with the company's actual stock price. It doesn't always work out that closely, but it's not unusual that it does. In this report, the resulting valuation multiples are compared against those in the company's default auto and suppliers sector. The ones labeled CUR, or CUR, are derived from the company's current trading value, and those labeled PRO, P-R-O, are based on the projected values, which are the consensus values in this case. As we saw, those two values are virtually identical, but they may not be for your company. The company's values are plotted in blue, and the industry consensus breakpoints run red to green. Look at the lower left chart. The company's classic enterprise valuation multiple is relatively high, 75th percentile, making the stock appear to be relatively expensive. But the EVA valuation metrics are much closer to the industry median. The forward-looking EVA momentum growth rate implied by the company's valuation, plotted in the lower right corner, has consistently run near the sector median and now is as well. Another key multiple is based on MVA, or market value added. That is the spread between the firm's market value and its invested capital. It measures the owner's wealth and the firm's franchise value. To make it a ratio, we express it as a percent of sales. It's about 40% for S&P. There's 40 cents of wealth creation and franchise value per dollar of sales, and that puts the value at the 62nd percentile in industry. These indicate that the company's valuation, based on the consensus forecast, is in fact much more conservative and credible than the enterprise multiple suggests it is. But why the difference? This chart shows why. The company's EBITDA margin is low for its industry, just 28th percentile, and forecast to rise only to the 31st percentile. That understates the firm's true profitability, however, and thus leads to an overstatement of its multiple. It is misleading because the company's capital charges are much lower than its peers. So good, so low, it warrants a percentile score well over 80. EVA margin, which consolidates both, is forecast to improve and reach well above 60th percentile. Couple that with near median sales growth, and the EVA momentum over the plan is upper quartile. And it is EVA momentum that determines how much value is created over the plan. This is a classic and actually fairly common example of where conventional valuation metrics fail to detect the real performance and the real value that EVA reveals. In these charts, you can pinpoint specific drivers against peer consensus breakpoints, which plot in red and green. It shows that the company's SG&A costs are notably high, as are its working capital days. The plant base, though, is notably low, as is the investment in intangibles like R&D and ad spending. We'll use these insights later on to develop a revised plan. But first, and at last, it's time for the PRVit analysis. The sample report you see is based on grading the consensus forecast for Standard Motor products. I repeat, in practice, PRVit's main application is to grade a company's own business plan, but this is what I can show as an example. The forecast performance score is 63 out of 100. That's a function of the EVA margin that analysts are projecting the company will earn 3 years out, which, as we saw, gets above 2%. And the EVA momentum they expect it will generate over the next 3 to 5 years, which runs at 0.5% for the first 3 years, then slows to 0.2% for the 3rd to 5th year out. The model considers both and traces out the full projected arc of the EVA curve. The scores here are based on comparisons with consensus projections for the entire universe of U.S. stocks. You can toggle the buttons at the top of this report and rate the values directly against the company's sector peers. Standard Motors garners a very low risk rating, just 2, based on its relative stability in stock price and EVA margin and the strength of its cash flow and credit posture. Now combine those two, take P minus R to compute a risk-adjusted EVA performance score as a proxy for the firm's intrinsic value, and rate that against all other firms. That works out to an intrinsic value score of 82. It's a rather impressive combination of above average performance and low risk. The question is, what do you have to pay for it? At its current stock price, the company is trading for a composite valuation score of 48. In other words, its valuation multiples fall very close to the middle of the U.S. market universe pack. That's based on judging a set of forward-looking multiples to book value, earnings, cash flow, and EVA. Look to the upper right heat map chart. The V-score plots backwards, right to left, and P minus R plots north-south. Fairly valued stocks plot along the white diagonal, where intrinsic value and trading value correspond. Standard Motor plots in the upper right green zone, which designates a buy. It has a favorable balance of P minus R compared to V. It's relatively cheap compared to what you get. Its PRVit score is thus 83, but, and this is a big but, that is the score against all stocks in the U.S. market universe. The more apt comparison is against the stocks in its sector, U.S. auto and supplier companies, and those stocks as a group are currently getting an unusually high rating. In other words, investors are heavily discounting the forecast prospects for the sector, so the stocks in general look cheap. To put a number on it, the median auto stock has a PRVit score of 79 relative to the market, which means Standard Motors' score of 82 is no longer exceptional. Judged and rated against its sector peers, its in-industry score, which is the official PRVit score, is just 63, which means it is essentially fairly valued at its current price, and assuming performance falls in line with consensus expectations. It plots right along the fair value diagonal when compared to peers. PRVit ratings, incidentally, are always evenly spaced from 0 to 100 across every sector. There's always as many buys as sells. PRVit is a pure stock rating system. There's no built-in bias to buy or short the market or a sector, and it appears to work. If you buy the best rated stocks across all sectors and short the lowest rated ones, you would have earned a much higher return than the market at much lower risk. It's another rather strong indication that stocks are magnetically drawn toward their fundamental EVA values. Now let's run an accelerated business plan through the model. I use the FE drivers template to simulate nearly doubling CapEx spending and increasing it by $10 million a year to support a more ambitious sales growth strategy. And we tackle two weaknesses noted before. We slash overhead and SG&A costs and cut working capital days from 135 to 80. The result? EVA triples from 30 million to 90 million. EVA margin reaches an eye-popping 7.2%. And EVA momentum runs at the breathtaking rate of 1.5% a year. The discounted EVA value of the revised plan reaches $73 a share compared to $42 before. Let's toggle before and after. All the indications except EBITDA margin skyrocket. EBITDA continues to understate the company's performance and value because EVA and EVA momentum really determine it. Now let's toggle the PRVit score before and after. The turbocharged plan steps up the P score from 63 to 85 as the forecast for EVA margin and EVA momentum really take off. That lifts the PRVit score compared to peers from 63 to 81, making the stock a definite buy as it should be, considering that the discounted value of this plan is $73 a share compared to the current price of $42. PRVit gives you another perspective on the value of your plans and the suitability of your financial goals, not as a matter of opinion and beyond the discounting of projections. It is a statistically robust reading of the relative value of your strategy as set by investors today. And it is a built-in feature of the EVA software system from EVA Dimensions. Thank you for listening.